Today, I'm going to break down a principle that changed everything for me. And if you understand it correctly, it will change everything for you too. This isn't theory. This isn't philosophy. This is mathematics applied to wealth creation, and mathematics doesn't lie. I'm going to show you exactly why most investors fail despite having access to the same information as successful investors. And I'm going to give you a framework that eliminates the emotional mistakes that destroy wealth. The traditional approach to investing is fundamentally flawed because it ignores human psychology and mathematical reality. People hear about compound interest and they think, wonderful, I'll invest some money and watch it grow exponentially. But here's what actually happens. They invest inconsistently. They panic during downturns. They chase performance. They withdraw funds at precisely the wrong moments. Then they wonder why their results don't match the textbook examples of compound growth. I've seen brilliant minds, people with advanced degrees, people who understand complex mathematical concepts completely fail at building wealth. Why? Because knowing about compounding and actually implementing a system that harnesses compounding are two entirely different things. The 8-4-3 rule isn't just about numbers. It's about creating a framework that forces you to behave rationally when everyone else is being irrational. It's about sequencing your financial decisions in a way that aligns with mathematical logic rather than emotional impulses. Here's the core thesis. Wealth creation through compounding requires three things that most investors never achieve. First, you need a high initial growth rate to establish momentum. Second, you need to sustain a reasonable growth rate over an extended period. Third, and this is where most people fail completely, you need to understand the mathematical relationship between time, returns, and contribution frequency. The 8-4-3 rule captures all three elements in a framework that actually works in practice, not just on paper. Now, let me explain what the 8-4-3 rule actually means, because this is where precision matters. For the first 8 years of your investing life, your primary focus should be on maximizing your contribution rate and accepting higher volatility for higher expected returns. You're building the foundation. You're establishing the base that everything else will compound from. During this phase, the absolute dollar amount doesn't matter as much as the habit and the growth rate. This is your accumulation sprint. You're running hard while you have the energy and the time horizon to recover from any temporary setbacks. After 8 years, you shift. For the next 4 years, years 9 through 12, you transition to a more balanced approach. You're still contributing consistently, but now you're optimizing for risk-adjusted returns. You're no longer chasing maximum growth at any cost. You're building sustainability into your system. This is where most investors make a critical error. They either stay too aggressive and get wiped out in a downturn, or they become too conservative too early and sacrifice years of potential growth. Both mistakes are costly, but the mathematics shows that premature conservatism is often the more expensive error. Then comes the final phase. After 12 years of disciplined execution, you enter what I call the compounding acceleration phase. For the next 3 years, years 13 through 15, something remarkable happens mathematically. Your portfolio has reached a size where the absolute dollar growth from returns starts to exceed your contributions. This is the inflection point most investors never reach because they violated the principles in the earlier phases. They interrupted the compounding, they panicked, they got greedy, they changed strategies at precisely the wrong moment. Let me give you a concrete example that illustrates why this framework is so powerful. Imagine two investors. We'll call them Investor A and Investor B. Both start with nothing. Both have the ability to save $500 per month. Investor A follows conventional wisdom. He invests cautiously from the beginning, gets conservative returns of about 5% annually, and maintains this approach for 15 years. He's consistent, he never panics, he does everything the traditional advisors tell him to do. He's the model investor according to mainstream financial planning. Investor B follows the 8-4-3 framework. For the first 8 years, she invests aggressively, targeting asset classes with higher expected returns. Yes, she experiences more volatility. Yes, her account value jumps around more. But over those 8 years, she averages 12% annual returns. During years 9 through 12, she shifts to a more balanced portfolio, averaging 9% returns. Then in years 13 through 15, she maintains a portfolio targeting 8% returns with lower volatility. At the end of 15 years, Investor A has built a respectable portfolio. He's done well by conventional standards. He has roughly $135,000. Not bad. He followed all the rules. But Investor B, who followed the 843 framework, has accumulated over $220,000 with the exact same monthly contribution. That's not a small difference. That's not margin of error. That's an $85,000 gap created purely by understanding how to sequence risk and returns properly. Now, I can already hear the objections. Some of you are thinking, but what about the risk? What if there's a market crash during those first 8 years when she's invested aggressively? This is where most people's thinking breaks down completely. They confuse volatility with risk. They confuse short-term price fluctuations with permanent capital loss. When you're in the accumulation phase, when your portfolio is still small, volatility is your friend, not your enemy. A market crash during your accumulation years means you're buying assets at discounted prices. You should be hoping for volatility early on, not fearing it. Let me explain the mathematics behind this, because this is crucial. When your portfolio is worth $10,000, a 20% market decline costs you $2,000 in paper losses. Painful? Perhaps emotionally, but mathematically insignificant in the context of building long-term wealth. But here's what most people miss. That same decline means you're now buying assets at a 20% discount with your monthly contributions. Over the next several years, as markets recover, which they historically always do, those discounted purchases generate outsized returns. Compare that to someone who experiences a 20% decline when their portfolio is worth $500,000. Now we're talking about a $100,000 paper loss. The psychological impact is entirely different. The mathematical impact on their wealth trajectory is substantial. This is why the 843 framework sequences risk appropriately. You take higher volatility when it mathematically benefits you, and reduce volatility when your portfolio size makes it genuinely risky. The second major lesson embedded in this framework is about contribution consistency versus market timing. I've watched countless intelligent people destroy their wealth-building potential by trying to time the market. They contribute heavily when markets feel safe, when everyone is optimistic, when prices are high. Then they stop contributing or even withdraw funds when markets decline, when prices are low, when the mathematical opportunity is greatest. This is the exact opposite of rational behavior, yet it's exactly what most people do because they're driven by emotion rather than logic. The 843 rule eliminates this problem entirely through its structure. You commit to consistent contributions regardless of market conditions during the entire 15-year period. But here's what makes it powerful. Your contribution amount can increase as your income grows, but you never decrease contributions because markets are volatile. You never stop because you're scared. You never pause because economic news is negative. The consistency is non-negotiable. This single principle, contribution consistency, probably accounts for half of the performance difference between successful and unsuccessful investors. I'll share a principle that guided my entire career, whether in mathematics or in investing. The signal is always hidden in the noise. Markets generate enormous amounts of noise, daily fluctuations, news headlines, expert predictions, emotional reactions. None of that is signal. The signal is the long-term expected return of productive assets, the mathematical advantage of consistent accumulation, the geometric power of compound growth. The 843 framework keeps you focused on signal while everyone else is reacting to noise. Think about it this way. During the first 8 years, you're building a mathematical engine. Every dollar you contribute is a worker you're hiring. Every month you invest consistently, you're adding more workers. These workers, your invested dollars, generate returns. Those returns create new workers. Those new workers generate more returns. This is the compounding mechanism but it only works if you keep hiring workers consistently and you don't fire them just because the economy looks uncertain. Here's something most investors never calculate, and it's a critical insight. During the early years of wealth building, your contributions matter more than your returns. Let me repeat that because it contradicts almost everything you hear from financial media. In the first 8 years, the dollars you add matter more than the percentage returns you earn. If you have a $10,000 portfolio and earn 15%, you made $1,500. If you contribute $6,000 that year, you added $6,000. Your contribution was 4 times more important than your return. But here's where the mathematics shift, and this is why the 843 framework is structured the way it is. By year 12 or 13, if you follow the system correctly, your portfolio might be worth $200,000 or more. Now, a 10% return generates $20,000. Your annual contribution of $6,000 is still important, but the compounding is starting to take over. By year 15, the returns on your portfolio are likely exceeding your contributions. This is the inflection point. This is where compounding transitions from theory to tangible reality. Most people never reach this inflection point. They never reach it because they interrupt the process. They cash out for a down payment on a bigger house. They reduce contributions because they want a nicer vacation. They panic during a market decline and sell at the bottom. They switch strategies every few years, chasing whatever approach performed well recently. Each interruption resets the compounding clock. Each disruption ensures they never reach the phase where compounding does the heavy lifting. The third critical element of the 843 rule is about psychological sustainability. This might seem contradictory coming from someone who spent his career removing emotion from decision-making, but here's the reality. You cannot maintain a strategy you psychologically cannot tolerate. If you're losing sleep over portfolio volatility, you will eventually abandon the strategy at precisely the wrong moment. This is mathematical certainty, not speculation. I've seen it happen hundreds of times. The pattern is always the same. The structure of 843 creates psychological sustainability through progressive risk reduction. During the first 8 years, your portfolio is small enough that volatility shouldn't genuinely threaten your lifestyle. Yes, the percentage swings are large, but the absolute dollar amounts aren't life-changing yet. This is when you can psychologically tolerate aggressive positioning. A $10,000 portfolio dropping to $8,000 is unpleasant, but it doesn't change your life. You still have your income, you still have your career, you're still building. By the time you reach years 9 through 12, 2 things have happened. First, your portfolio has grown substantially, making volatility more impactful in dollar terms. Second, you've developed investing discipline through 8 years of consistent execution. You're no longer a beginner reacting emotionally to every market move. You've lived through at least one significant correction. You've experienced the psychological challenge of watching your portfolio decline and continuing to contribute anyway. This experience is invaluable. It creates resilience that cannot be taught, only earned. In years 13 through 15, you've built substantial wealth. Now, volatility represents real money, not just percentages on a screen. But you've also developed the psychological resilience and experience to handle it rationally. The progressive structure trains you to handle increasing amounts of capital without making emotional mistakes. It's like weight training. You don't start by lifting 300 pounds. You build up progressively, allowing your body and mind to adapt. Let me tell you about a pattern I observed repeatedly throughout my career. Young investors with small portfolios often claim they have high risk tolerance. They say they can handle volatility. They insist they won't panic during downturns. Then a 20% market decline happens, and they discover their actual risk tolerance is much lower than they imagined. They sell at the bottom, lock in losses, and ensure those losses become permanent rather than temporary. I've watched this pattern destroy more wealth than almost any other mistake. The 843 framework protects you from yourself. It forces you to take appropriate risk when you can afford it and when you psychologically haven't yet been tested by a real bear market. Then it gradually reduces risk as your wealth grows and as you've proven to yourself that you can handle volatility rationally. This isn't coddling. This is designing a system that accounts for human psychology while maximizing mathematical outcomes. The best system isn't the one that looks perfect on paper. It's the one you can actually execute consistently in the real world. Here's another insight most investors miss entirely. The sequence of returns matters enormously, but not in the way conventional wisdom suggests. People worry about experiencing poor returns early in their investing career. They think this will doom their long-term results. This is exactly backward when you're in the accumulation phase. Poor returns early, while you're contributing consistently, are actually beneficial. You're buying assets at lower prices. When returns eventually recover, those early purchases generate outsized gains. The dangerous sequence is the opposite. Strong returns early, followed by poor returns later. If you experience strong returns in your first 8 years, your portfolio grows quickly, which feels wonderful. But if you then experience a significant downturn in years 12 through 15, when your portfolio is much larger, the dollar impact is devastating. The 8-4-3 framework addresses this by reducing risk exposure as your portfolio grows, protecting against late-stage sequence risk. Let me be specific about implementation, because general principles without execution are worthless. During your first 8 years, you should target asset classes with higher expected returns and higher volatility. This typically means a heavy allocation to equities, potentially with geographic and sector diversification, but accepting the volatility that comes with growth-oriented assets. Your monthly contribution should be automatic, non-negotiable, and ideally increasing as your income grows. Set it up so it happens before you even see the money. Pay your future self first, not last. During years 9 through 12, you transition to a more balanced portfolio. You might shift from 90% equities to 70% equities. You might add some exposure to less volatile asset classes, but you maintain consistent contributions. You don't reduce risk dramatically. You're optimizing the risk-return trade-off, not abandoning growth. This is a gradual shift, not a sudden change. You're recalibrating, not rebuilding. In years 13 through 15, you continue the transition. Perhaps you move to 60% equities, 40% lower volatility assets. You're still growing wealth, but you're protecting the substantial capital base you've built. You're recognizing that a major drawdown at this point could set you back years. The mathematics of recovery are brutal. A 50% loss requires a 100% gain just to break even. The larger your portfolio, the more important loss avoidance becomes. After 15 years, you reassess completely. You've now built serious wealth through disciplined execution. The next phase of your investing life requires different strategies, different risk management, different objectives, but you've established the foundation that most investors never create. You've proven to yourself that you can execute consistently. You've developed the discipline and psychological resilience that wealth preservation requires. You're now playing a different game entirely. Now, let me address something critical. Some of you are thinking, 15 years is too long. I want wealth faster than that. I understand the impulse, but here's what I learned over decades. Trying to accelerate compound growth beyond what mathematics allows always, and I mean always, requires taking risks that are more likely to destroy wealth than create it. You end up gambling, not investing. You end up reacting emotionally, not thinking logically. You end up chasing returns that don't exist or taking on risks you don't understand. 15 years seems long until you realize that 15 years will pass whether you follow this framework or not. The question isn't whether 15 years is a long time. The question is, where do you want to be 15 years from now? Do you want to have built substantial wealth through disciplined execution? Or do you want to have chased dozens of strategies, reacted emotionally to market moves, and ended up with mediocre results? Time passes regardless. The only question is what you do with it. I've watched people waste decades because they couldn't commit to a rational framework for 15 years. They spent 30 years jumping between strategies, always looking for something better, never executing anything consistently. 15 years of disciplined execution beats 30 years of inconsistent experimentation every single time. The mathematics are unambiguous on this point. Consistency over extended periods beats sporadic excellence every time. Here's something else most people don't consider. The 8-4-3 framework compounds not just your wealth, but your investment, knowledge, and discipline. After 15 years of consistent execution, you've experienced multiple market cycles. You've lived through corrections, recoveries, periods of irrational exuberance, and periods of excessive pessimism. You've learned to separate signal from noise. You've developed the psychological resilience to maintain rational behavior when everyone around you is panicking or euphoric. This knowledge and discipline becomes your permanent competitive advantage. It allows you to continue building wealth for the next 15 years and the 15 years after that. Most investors never develop this advantage because they never stick with any approach long enough to truly master it. They are perpetual beginners, always starting over, never building on previous experience. The 8-4-3 framework forces you to become an expert through sustained practice. Let me give you one more concrete example of why this framework works and conventional approaches fail. Consider someone who follows the standard advice to invest conservatively when young because you have more time to recover from mistakes, then invest more aggressively as you approach retirement to catch up if you're behind. This is exactly backward mathematically. It's advice that sounds reasonable but crumbles under mathematical scrutiny. When you're young, you have limited capital but unlimited time. You can afford temporary losses because you have decades to recover and you're constantly adding new capital. This is precisely when you should accept volatility for higher expected returns. The mathematical value of time is enormous when you're young. Wasting it on conservative investments is strategically foolish. As you age and accumulate wealth, you have more capital but less time. A major loss at this stage might not be recoverable before you need the funds. This is when risk management becomes critical. The 8-4-3 framework aligns with mathematical logic. It sequences risk appropriately. It recognizes that risk tolerance should be determined by your financial situation and time horizon, not by your age or feelings. This is the difference between investing based on logic and investing based on conventional wisdom that sounds good but doesn't hold up to mathematical scrutiny. Let me share another principle that most investors violate constantly. Diversification is not about owning more things. It's about owning things that respond differently to the same economic conditions. I've seen portfolios with 50 different stocks that all move together because they're all exposed to the same underlying risk factors. That's not diversification. That's the illusion of diversification. During the first 8 years of the 8-4-3 framework, you can accept concentration in high-growth assets because your portfolio is small and you're adding capital consistently. But as you transition through years 9 through 15, genuine diversification becomes increasingly important. Genuine diversification means holding assets that perform well in different economic environments. Some assets that perform well during inflation, some during deflation, some during economic growth, some during economic contraction. This type of diversification reduces volatility without necessarily reducing expected returns. It's one of the few free lunches in investing, but only if you understand what diversification actually means mathematically. Here's something I want you to understand deeply. The 8-4-3 framework isn't rigid. It's a guideline based on mathematical principles, not a set of commandments carved in stone. If you're currently 35 years old with no savings, you don't have 8 years to be aggressive. You need to compress the timeline. If you're 22 years old, just starting your career, you might extend the aggressive phase beyond 8 years. The specific numbers matter less than the underlying principles. Progressive risk reduction as wealth grows. Consistent contributions regardless of market conditions. Focus on building the habit first, optimizing returns second. The framework is adaptable, but the principles are not. You cannot skip the accumulation phase and expect compounding to work. You cannot interrupt the process repeatedly and expect to reach the inflection point. You cannot ignore risk management as your portfolio grows and expect to preserve wealth. These are mathematical truths, not opinions. Let me tell you about the single biggest mistake I see investors make with compounding. They understand the concept intellectually, but they don't internalize the nonlinear nature of exponential growth. The first few years feel slow. You contribute consistently, markets go up and down, but your portfolio doesn't feel meaningfully larger. So people get discouraged. They think it's not working. They abandon the strategy right before it would start accelerating. This is like planting a bamboo tree. For the first 5 years, you water it daily and see almost nothing, just a tiny shoot that barely grows. Then in year 6, it grows 90 feet in 6 weeks. Compound growth follows a similar pattern. It feels linear for years, then suddenly becomes exponential. But you only get to the exponential phase if you don't give up during the linear phase. The 8-4-3 framework structures this mathematically. Years 1 through 8 are your linear phase. Years 13 through 15 are when exponential growth becomes visible and tangible. Now, let me address fees and costs, because this is where many investors unknowingly destroy their compound growth. Every dollar you pay in fees is a dollar that can't compound for you. It's not just the dollar today, it's the dollar plus all the future growth that dollar would have generated. Over 15 years, a 1% annual fee difference can cost you 20 to 30% of your final portfolio value. That's enormous. That's the difference between comfortable retirement and struggling retirement. During your 843 execution, minimize fees ruthlessly, use low-cost index funds or exchange-traded funds. Avoid actively managed funds with high expense ratios unless they have proven sustained outperformance that more than compensates for the fees. Don't trade frequently. Every trade has costs, both explicit and implicit. The more you trade, the more you erode your compound growth. Remember, the goal is to let compounding do the work, not to constantly tinker with your portfolio. Let me share something about taxes, because tax efficiency is another area where compound growth gets destroyed. Every time you sell an investment in a taxable account, you trigger taxes. Those taxes reduce your capital available for compounding. The most tax-efficient strategy is often the simplest. Buy and hold for the long term. Let compounding work without interruption. Use tax-advantaged accounts whenever possible. Understand the difference between short-term and long-term capital gains. These details matter enormously over 15 years. Here's a principle that took me years to fully appreciate. Simplicity is a competitive advantage in investing. Complex strategies sound sophisticated. They make you feel smart, but complexity introduces more points of failure, more opportunities for mistakes, more psychological burden. The 843 framework is deliberately simple. 3 phases, clear guidelines for each phase, consistent execution, no fancy hedging strategies, no complex derivatives, no leverage, just disciplined, consistent, mathematically sound execution. I've seen investors with PhDs in finance underperform simple index investors because their strategies were too complex to execute consistently. Complexity doesn't generate returns. Disciplined execution of sound principles generates returns. Never confuse complexity with sophistication. The most sophisticated investors I've known all had one thing in common. They executed simple strategies consistently, without deviation. Let me tell you what happens after year 15 if you followed this framework correctly. You have substantial capital, you have proven discipline, you have psychological resilience, you have the foundation for genuine wealth. At this point, you have options most people never achieve. You can continue the strategy indefinitely, compounding wealth for another 15 years. You can shift to wealth preservation mode, reducing risk further and focusing on maintaining what you've built. You can use your capital to generate income, living off returns rather than contributions. The choices are yours because you've created the foundation that makes choices possible. But here's what most people don't realize. The discipline you developed executing the 843 framework is more valuable than the money itself. That discipline transfers to every other area of life. The ability to execute consistently despite emotion, the ability to think long term when everyone else is focused on short term, the ability to separate signal from noise. These are meta skills that compound throughout your entire life, not just your portfolio. I want to address one more objection I know some of you have. You're thinking markets are different now than they were historically. Returns won't be as high going forward. Valuations are elevated. Interest rates are changing. There are legitimate concerns about future returns, but here's what you're missing. The 843 framework doesn't depend on specific return assumptions. It's a structure for rational behavior regardless of what returns actually materialize. If future returns are lower than historical averages, and they might be, then the framework becomes even more important, not less important. When returns are harder to achieve, you cannot afford to make emotional mistakes. You cannot afford to interrupt compounding. You cannot afford to pay high fees or make poor risk management decisions. The framework ensures you maximize whatever returns are available by eliminating the behavioral mistakes that destroy wealth. Here's my final message, and I want you to really hear this. Wealth building is not about finding secrets. It's not about insider information. It's not about being smarter than everyone else. It's about executing simple, mathematically sound principles consistently over extended periods. The 843 framework gives you those principles. It gives you a roadmap from where you are now to substantial wealth 15 years from now. But I cannot execute it for you. Only you can do that. The difference between people who build wealth and people who don't isn't intelligence. It isn't luck. It isn't connections. It's the willingness to commit to a rational framework and execute it without deviation, regardless of emotion, regardless of market conditions, regardless of what everyone else is doing. That's the difference. That's the entire difference. Before I wrap this up, I want you to do something for me. I want you to commit to this framework publicly. Leave a comment below describing exactly how you're going to implement the 843 rule in your investing life. Be specific. Tell me where you are currently in your investing journey. Tell me what changes you're going to make based on what you've learned today. Tell me how you're going to ensure consistent execution for the next 15 years. Public commitment creates accountability. Accountability increases follow-through. Follow-through is what separates people who build wealth from people who just talk about building wealth. And if you found value in this breakdown, hit that like button. Not for me, for the algorithm. The algorithm determines who else sees this content. If you want more people to understand how wealth is actually built mathematically rather than emotionally, that like button helps spread the message. We need more people thinking rationally about wealth. We need more people understanding that success is about discipline and mathematics, not luck and speculation. Let me summarize the key principles because these are worth repeating. First, compounding only works if you execute consistently over extended periods without interruption. Every time you interrupt the process, you reset the clock and ensure you never reach the phase where compounding accelerates. Second, risk should be sequenced appropriately, with higher volatility accepted early when it mathematically benefits you and reduced later as your capital base grows and sequence risk becomes genuinely dangerous. Third, consistent contributions matter more than returns in the early years, but returns eventually overtake contributions if you don't interrupt the process. Understanding this transition is critical to maintaining motivation during the slow early years. Fourth, the 843 framework creates psychological sustainability by progressively reducing risk as your ability to handle volatility decreases and as the dollar impact of volatility increases. This alignment between risk exposure and psychological capacity is what allows long-term execution. Fifth, 15 years of disciplined execution beats 30 years of strategy hopping. Consistency compounds, experience compounds, discipline compounds. These intangible factors are often more valuable than the financial returns themselves. Sixth, the framework is adaptable to individual circumstances, but the underlying principles are mathematical truths that cannot be violated without consequence. The Jim Simons mindset isn't about finding shortcuts. It's not about getting rich quick. It's not about following your gut or trusting your instincts. It's about understanding the mathematics of wealth creation and building systems that harness those mathematics regardless of what emotions you're feeling or what chaos is happening in markets. The investors who succeed long-term are the ones who can separate signal from noise, who can maintain rational behavior when everyone else is being irrational, and who can execute consistent strategies over timelines that most people find psychologically impossible to maintain. The 843 rule gives you that framework. It gives you a clear path from where you are now to substantial wealth 15 years from now, but only if you execute it, only if you commit to it, only if you refuse to let emotions, market volatility, or conventional wisdom pull you off course. I've given you the map, I've explained the mathematics, I've shown you why it works and why alternatives fail. The rest is up to you. The mathematics doesn't care about your feelings. The mathematics doesn't care about market crashes or bull markets or economic predictions. The mathematics simply compounds whatever inputs you provide. Give it consistent contributions, appropriate risk-taking, and uninterrupted time, and it will generate wealth. Interrupt it, and it resets. The choice is entirely yours, but make no mistake, it is a choice you're making every single month, whether you realize it or not. Every month you contribute consistently is a vote for your future wealth. Every month you skip or reduce contributions is a vote for mediocrity. Your future is being determined by those votes right now, today, this month. Choose wisely.